Now let's go to the next topic of the day, which is another way of doing this leveraging. Not via shorting, but via something we call risk-free borrowing. Right, and then, so the first question here to ask is that when we do risk-free borrowing, is it risk-free for who? We'll get back to that in a second. I want you to reflect on that. Who is it risk-free for? What does it mean that we have risk-free borrowing? All right, but first let's have a look at the model. Because shorting was pretty easy. You just remove the positivity constraint from your X, then you allow shorting. Now, if you want to allow risk-free borrowing, you have to do it explicitly in your model. And the way you do that is by introducing this variable that I call V minus. So V minus is your risk-free borrowing variable. It's a decision variable. So what happens here is that it says sum of your x's minus whatever you borrow has to be 1. So you get a bit of this effect still, right? So I can have sum of my x's can be 2. If my V minus is minus 1, that means that this equation is still correct, right? So in that way, here I'm explicitly entering a variable that is putting a limit on how much explicitly telling me how much I can borrow, and then I can put a limit on it if I want as well. So if I want to say, for example, I want to allow a leveraging factor of 2. So that is exactly what I would do. So I say my sum of x's could be 2. That means that the V minus should be less equal 1, right? So if V minus, if I put a limit on that of 1, it shouldn't be greater than 1, means that I don't want to allow leveraging of a more than factor 2, right? And you get the leveraging of factor 2 means that if the markets go up by X%, then I gain 2 times X%, right? And if the markets go down by Y%, then I lose 2 times Y%. So that the leveraging factor is the number that you multiply by your original amount of loss or gains if you have a leverage position, right? Right. So this is the V minus, and then the borrowing, the risk-free borrowing, which is the V minus, that comes into the first term of your objective function. So what you have there is that we are summing over mu I times xi. That's still your expected return. But from the expected return, we are now deducing the returns that you pay for your risk-free borrowing. So whatever rate, the RF is the risk-free borrowing rate multiplied by V minus, which is how much you borrow. So that's the payment that you pay for your risk-free borrowing. You deduce that from your return, right? And now comes the question. So when I say risk-free borrowing, is it risk-free for the investor, or is it risk-free for the bank or whoever is actually giving you this loan? Yeah.
It's risk-free for the bank because they get the payment for new money.
Correct. So it's risk-free, and again, it goes back to the same principle of margin, because you have to have a margin account. So they are sure that they can take their money, even if you lose money, they can reduce it, they can take their payments from your margin account. So in that sense, it's risk-free for the bank. That's why that rate, the RF, is the risk-free rate. It's a low rate, but it's because it's risk-free for the bank. They actually managed to borrow that money to you at the cheapest possible rate, which is the risk-free rate, or close to the risk-free rate. And the idea with that is of course, that they want you to invest more than actually what you kind of can afford with your own money, right? So this is, now we're talking about shorting, and especially when you use shorting to do leveraging, or you're using, in this case, risk-free borrowing in order to do leveraging. Now we are entering an area of investment which could be much more risky than just what we did in the plain vanilla Markovich last week. So you're investing essentially much more money than you have, right? And do you have just to give you an idea of in different exchanges how much leveraging is allowed? Do you have an idea of if you were to go on a platform like Saxo Bank and start trading, how much do you think they will allow you to short? Or
Kind of depends on what you're gonna apply.
yeah.
Like currencies is 40 times leveraging, I think.
Mm-hmm. Some currencies, and even some currencies even more. Probably some of them even maybe 50 times. Yeah. And
One of the stocks actually.
yeah, I mean, that could be also as much as maybe 20 times, 30 times, 40 times. So that's true. So they're actually it is quite easy. In other words, that you can go into these markets, and if you don't know what you're doing, and if you don't do your risk management right, you can get extreme returns, but that's also at extreme high risk. So that you can get wiped out within a few hours if you just go in and did, for example, this thing, and then the prices of IBM just went a little bit up, then you're wiped out, you lose your money and out. So that's what you would hear also sometimes, that people, when they say going into the financial markets is a bit like going into casinos. That what they mean is not. I mean, it's things get kind of mixed up, but it's if you are going into a platform and the first thing you're doing is that you're entering into a big leverage position, then the effect of which could be something like going into a casino. So whereas if you say, well, the V minus has to be not greater than 0.5, right? So you will still allow some degree of leveraging, but that would be a leveraging of 0.5 factor, right? So it's a small amount of leveraging. You can go 1.5 times your money, or it would be a leveraging of 1.5 if V minus was 0.5. Right? Yeah.
V minus can reach 40, 50.
So when you say when we say let's say in your case, if you said they allow 40 times leveraging, right? So what does 40 times leveraging mean? That means some of your excess has to be equal, can be as much as equal what?
41.
Just 40. Because being normally not being leveraged means a leverage factor of 1. 1 is kind of the base, right? So being leveraged 40 times leverage means that you have 40 times more than what you have, right? So to answer your question, if maximum leveraging allowed is 40, that means that sum of your x's may be 40, and that means it has to be less equal 40, right? Sum of your x's has to be less equal 40, means your V minus has to be less equal 39, right? So that's how you would use this model. So you decide what is your maximum leveraging allowed, and this is a function of your risk management. So you have to find out, based on exactly as what you said, depending on what market you're looking at, and what is the risk of that underlying market. If you're looking into individual stocks or into currency or into broad indices, there could be a bit different levels of leveraging, which could make sense. But I would say that if you want to go like 40 times leveraging in essentially anything, that means it's a bit, effect of which is a bit like going into a casino, right? So that's something that you should just keep in mind as a rule of thumb. Yeah.
But if we turn it into money, so if I would own $1,000, I could borrow 29,000 from the bank, or
correct. So if you in this case, if you come with $1,000, leveraging of 40 means you can invest. You have 1,000. You can invest for 40,000, 40 times your money, and that means essentially that you're borrowing 39,000 krona from the bank.
and they would say
The risk-free, that could be 0.5% these days maybe, or something to that effect, 1% per year, right? So the idea essentially then is, and as you see from the model here, so you will see as far as mu is greater than RF, and as far as you have a big focus, the lambda is big, is too small, is closer to 0, then there's more focus on maximizing expected return, then the model wants to borrow, because you can always find an asset which in average gives a higher return than the risk-free return, right? But again, the more weight you put on the risk, that is one way of limiting it. The other way of limiting it is directly to say, well, I don't want to have anything, I don't want to get higher than a factor of 10. They have an exercise that you can work with on this one in particular, and see how it impacts your efficient frontier, right? There is one final thing I would probably say about this, which is interesting to have a look at. So it's always nice to, when you're looking into the markets, if you want to do your analysis, you want to see what is your probability of ruin, or probability of default, right? So you can draw a graph like this, where you can say this is level of this is leveraging, right? So you start from, let's say, and you start from 1, and it goes to, let's say, 100, right? And this is your probability of default, right? So this is the probability that you lose all your money, right? And if you were looking into, I think there was a study done on some broad market indices on any 10-year period going 130 years back or something to that effect, and looking at, for different levels of leveraging, when is it that at what level of leveraging you can be almost sure that you lose all your money. And it's interesting to see how this graph behaves. And the interesting thing is that, and you will see it no matter what market you look at it, that in the beginning there's almost a probability. So the probability of ruin here is 100%, and here is 0%, right? So no matter what happens, never observed, you never observe that you'll actually go bankrupt, right? So if you go into a broad index, S&P 500 or some world index, right, which is maybe 500 stocks or 4,000 stocks all in one. I mean, individual companies can go down, but 500 companies or 4,000 companies don't collectively all go down at the same time, right? So you never observe in an index that there is a probability. So it's almost 0 in the beginning up to a certain level, maybe up to 2 or even or something. And then it starts going up. And then at some point, it goes like this. And it almost goes to 100%. Right? And it's, what is interesting is, at some levels that you have to find out what is, when do you hit the wall, right? And this level here is that level of leveraging, let's say it could be 4 maybe. You don't really want to be on the right side of the wall, right? Because on the right side of the wall, what does it mean? That means that if you're looking at, let's say, 10-year periods for the last 130 years, so you have 13 observations, and in all of them, there has been at least one case where this index has fallen with more than 25, a bit more than 25%, right? So you can be sure that you're gonna lose all your money if you were over 4, and you don't want to maybe be close to it, so maybe you'll say, okay, well, maybe I'll stick with 3, right? So that would be an easy way of finding out, you know, how can I work with leveraging in a way, for a particular market that is, historically at least, you know, for a long, long period of time, I can be sure that it's not going to ruin me completely, right? Because the last thing you want to happen when you are engaging in leveraging is that you have a high probability of ruin. And the interesting thing about this graph is that it just hits the wall at some point. Because that's a simple fact of, it's the question of, you know, by historically, based on the nature of the underlying, what can you expect from its fall, right? And you know, just one fun fact maybe is that when you're looking into cryptocurrency, I don't know if any of you is trading cryptocurrency, and you know how much they can fall within seconds or days, right? And there are actually some exchanges, cryptocurrency exchanges, which allow these kinds of crazy 40 times, 50 times or more even, 100 times in some cases, leveraging, right? So if you want to combine how much cryptocurrency is how volatile it is, how much the price can change within a single day or even hour, and then combine that with leveraging of a factor of 40 or 50, then you can be sure to die. I mean, there's no doubt about that. So you don't want to really go into, you don't want to combine cryptocurrency for sure with shorting or leveraging, with one or other way of leveraging altogether. But in some other markets, again, as I said, maybe in broader indices or in currency markets, it could make sense. But still, you need to do some kind of analysis to make sure you want to keep yourself safely on the left side of the wall, right, of the leveraging debt wall, right? So that was all I would say about risk-free borrowing. Any more questions to that? There was one there.
Yeah, how does buying an ETF that is leveraged and just leveraging yourself, is the difference how much you pay for the ETF? Or how does it vary? Because I know there's
If you buy an ETF which is leveraged, right? So ETF, for those of you who don't know what an ETF is, ETF stands for an exchange-traded fund, and that's one way of normally that's one tradable index. So that normally an ETF is made of many, like could be hundreds or thousands of stocks underlying that, right? So the question was, as I understood it, that there are some ETFs which are leveraged beforehand, right? So you don't have to do it yourself. So you can buy, in the ETF markets, and there are some, I think, 8,000 to 10,000 ETFs worldwide. So some of these ETFs are not leveraged at all. Some of them are not short, but then you have some kind of, say, some funny ETFs that you have to be careful about. You have to at least know what you're trading. Some of these ETFs could be that in their construction, they are either short, or it could be they are leveraged, or they could be both, right? So you can get the short but not leveraged ETF of, let's say, SP 500, right? And if you did that, that means that if the SP 500 is going up, then you're losing money, and if it's going down, then you're gaining money. That's just the short version. But it could be also short and leveraged, or just leveraged. So it could be that you get the 5 times leveraged SP 500. That means you're gaining 5 times SP 500 whenever it goes up by 1, and the other way around, right? So you just have to be careful about that. You don't need to do the shorting yourself, but you need to study exactly how leveraged that ETF is. So you can find that description in the description of these. You just have to look it up on Google Finance. That it says that this is leveraged by a factor of X, right? So that's the way to find out. And then, so they have, the thing is that they do that. The idea behind those ETFs is that if you want to do this leveraging and you don't have access to the market so that you can go and get just the underlying and do the borrowing yourself, they kind of do it for you, or they do it more efficiently for you. But in my opinion, and from what I've seen, they are not the kind of ETFs which are traded all that much. So normally, kind of, I prefer my ETFs plain. So that means they should be long only and not leveraged. And then you can do all the other risky stuff on top of it yourself. But in some cases, it might make sense. I haven't been presented for very good cases of people why they would be using it. But it could be that there are some good cases. The problem is also that they normally cost a bit more. They actually charge you extra for this possibility of leveraging and for the possibility of shorting that you don't have on the original index. Other questions on shorting or risk-free borrowing? Right, so that was the second